What's going on, everybody? TG here, back with another video. Guys, before I start this video, I just want to say that right now only about 25% of my viewers are actually subscribed. If you guys enjoy this content at all and want to show the least bit of a support, just hit that subscribe button. It really means a lot to me. But let's go jump into this video, guys. So this video is all about the best strategy to do for smaller accounts. Now, when I say smaller accounts, I'm usually meaning accounts under $2,500. That's what I consider like a small account. And this is the perfect strategy for that. So it is called put credit spreads. And essentially what it's doing is basically betting that a stock will not drop under a certain price on a certain date. So for instance, I went ahead and sold two put credit spreads today, as you guys can see. This first one was with Amazon. I'm essentially betting that Amazon will not drop under 2,800 by January 15th of next year, so a couple months from now. And I got paid $420 to do so, but if it drops under, I lose about $1,320 or $1,380. I lose $1,380 if it drops under. So these are very high probable things that will happen. The probability of Amazon dropping another over 10% to go under 2,800 is very unlikely, especially with their rising earnings and the fact that the stock has already dropped over 15% from its highs. So to make this bet, I thought it was pretty safe, and I still think it's very safe. I mean, considering the fact that Amazon was mid 3,500s and now it's sitting at exactly 3,100, it would, like I said, it would have to drop over 10% in order for it to be in that 2,800 level. And there is a ton of support at 2,950 and at 2,850 as well. So the odds of it going down that much are very unlikely, especially by January with time on our side. So I went ahead and made that bet. I also made a Alibaba put credit spread, basically saying Alibaba will not drop under 220, and it is currently sitting at 255.20 right now. Alibaba has been doing really bad recently, which is why I did that. As you guys can see, it's down 18% in the past month, and it's due for a big run. Ton of analysts as well. If you look at Alibaba, every analyst is saying, now is a perfect time to get into Alibaba. Rare opportunity to get into the Alibaba train. Is Alibaba a stock? They really like it, except for this guy, Alibaba, the IPO disaster may be just the start. So a lot of people really like Alibaba, and the price targets of Alibaba are super high. It has very good earnings, and its PE ratio is only 25, which is extremely low for a growth company, which it is. To have a PE ratio that low is very insane. So I went ahead and did that. Like I said, it's got to drop over 10% as well from where it has to get to that, and then we're looking at levels that are just very, very little for that. So the probability of that happening, it's just very unlikely. It's very unlikely to happen. And we put up, for this one, for Alibaba, I got to see how much I got. I put up $124, and I forgot how much I'm risking. I think it may have been 1,000. Yeah, I think I'm risking 1,000 for that. But that's obviously, my very unlikely that it's going to drop down, another 25 points to go down that far. So like I said, it's unlikely to happen, or 35 points, my bad. Very unlikely to happen. And essentially you are playing the house in a casino. Like, that's a good way to look at it. People are betting, they're giving money up front for a chance to like 4 times their money. But the odds of that happening, and like if you go and even look at the the probability of it going down, you can go and check here. If we go to sell put, you'll see chance of profit. If you go all the way down to a 220, you'll see your chance of profit. It continues to increase and increase. So if we go down to the strike price, which is January 15th, and you go down to a 220, I have an 82% chance of profit for this particular trade. So those are really good odds. If you're playing roulette, you don't even get a 50% odds to make money. And like I said, someone pays me that money up front, and as long as Alibaba stays above that price, then I keep all the money. So I want to show you guys how to do this, and good stocks to do it on, and why I recommend you do long term out rather than short term. So leaps almost, if you will, not that far, but give yourself a couple months maybe to do it, because for a couple reasons. One, it's safer. Two, you get a lot more premium, which is obviously makes it safer because you're getting more money up front. So you get more premium and you have more time on your side, and you can let theta do its work as well. Whereas if you do it for a week out, and let's say it's a bad week, well, you're done. In this case, let's say Alibaba does have a bad week and goes down. Okay, it has time to get back up there. I'm not out of it. So if we're going to do it, let's do an example on Amazon. So obviously I can't sell a put on Amazon because I don't have $280,000. So I have the option to be like, okay, I think Amazon is going to stay above this price. And if we go back to that date, you can do any date if you want. If you want to do, let's say you want to do, New Year's Eve. Right before the new year, you think Amazon is going to stay above a certain price. You'd go over here to sell put, and you'd go down and pick whatever one. So you think, oh, I think it's going to stay above 3,000. The closer to the current price it is, the more money you're going to get, but the more risky it is. So you can go down a ton, and you can see your chance of profit increases, but you also make a little bit less. So, I mean, it makes sense. You're taking less of a risk, so you're going to get less money. So let's say you think, okay, I think Amazon's going to stay above $2,900 by the end of the year. So you'd go here, you'd click this button right here. So that's your first leg. You sell that put, and then you would buy the put underneath. So you could buy this put right here if you wanted to, or if you are super, super bullish, you can even buy one underneath here. This you need to put up more collateral. I believe it's $500 every leg under. So let's say we wanted to be safe and not risk that much. We'd put that here. So we'd get $5,750 from that, and we'd pay $5,580 from that, giving us a total credit of $170. Now we have to see how much we would get, how much you have to put up for that as well. And so we would put in, right now it's hard because there's very little volume for this. So we put like 1.7. We'd go review order. We have to see how much collateral we'd have to put up. And it's right when it says this, put credit spread. That's what we want to see. We want to see it say put credit spread. That's how you know you did it right. Remember, you don't want to buy the one above it. You want to sell the one above it, buy the one underneath it. Very important. So you would risk $1,000 and you would get that 170 initially. So the most you could possibly lose is $830. So if Amazon drops below 2,900 by December 31st, so it could be under it. It could be at 2,800 on December 30th, but even if it goes $1 above 2,900 on December 31st, well, you keep all that 170 and you don't lose your collateral. So, it's something to do. If you only have $1,000, that's an easy 17% gain right there off only $1,000. That's really, really good, especially for something that you have a high probability of making profit on. So it's a very interesting technique to do. Like I said, I don't recommend doing 1 week or 2 weeks out. I think if you're going to do it, your best bet is to do it at least a month or so out, because like I said, the more time you have on your side, the more money you will make, and the safer it is as well, especially if it's a quality company, like Apple, Amazon, Microsoft. Over time, these companies do well, especially ones that have been beaten down like tech. So this is actually a great time if you want to do that, and which is why I did it. So it's just something to do. If we went ahead and change this, let me show you guys. If we went ahead and moved this down one more, we'd get a lot more money for it. As you guys can see, we would get about, let's see what that is, $515. And let's see how much we'd have to put up in collateral. I believe it's about 2,000. I'm almost positive it's about 2,000. So sorry about the internet. I don't know why. Robinhood options after the close are very, very slow. So it's hard to get a good grip on what it is, especially on the laptop or desktop platform. It's a lot slower than it is on the mobile app, which is what I use. So yeah, you'd get $515 up front, and you'd risk $2,000. So your max loss would be $1,485, which is, like I said, that's a really good percent right there. A percent gain. Like I said, you get that $515 regardless, but you're obviously risking that you could lose another $1,485. So it's a really good strategy to do if you don't have a lot in your account and you want to be able to grow and do it a little safer than just buying a call outright. Because obviously if that doesn't work out, you could lose everything. Whereas this, you have some time on your side, you're getting some money up front, and your percent chance of winning is a lot higher. Now, I don't recommend doing this a lot just because it's very risky unless you're going to do far out leaps ones. Stocks tend to do very well over time if they're quality blue chip companies, which, like I preach, Amazon, Apple, Facebook, Microsoft, companies like that have time and time again proven that they will do good under any circumstance. Pandemic or not, Amazon and Apple are going to be fine. So you do a long-term leaps, put credit spread on one of these, and you should be fine. Obviously, things can go bad. We don't know what's going to happen with the market, but the odds of Amazon dropping another 10% over, despite already dropping like 15% from its highs with good earnings, is very unlikely. But anything's possible in this market. So obviously, be careful. Don't risk your entire account on something, but it's obviously a great way to make some good money up front. So, guys, I hope you enjoyed this video. I'm going to be going over a lot of different option strategies because a lot of you guys have been asking about that. Different ways to make money besides, like what I do, selling puts. But as you guys can see, when opportunities present itself like this, like when you see companies that are really good getting beat down for no reason, some of these plays are very, very good, especially if you give yourself some time. And like I said, with a January 15th strike price or strike date, it's very good. And our chances of winning are very, very high on that. And I like high probability. And like I said, you are the house in this situation. People come in and gamble. These people are gambling. They have a 18%, 15% chance of winning this trade, and they're going to throw up big money for it. So, it's something to do. It's a risk worth taking, I believe. And like I said, I'm very bullish on Amazon. And even though recently it's been, just getting beat down and staying in the same little channel, I'm still bullish. And even if it stays in the same channel as it is now, you still win this trade because it has to drop a lot in order for that to happen. So, guys, opportunities are out there to make money any sort of way you can, and this is just another one of those. So if you enjoyed this video, like I said, guys, remember to like and subscribe. We have a Discord channel in the link below. I post these trades that I make all the time in there. Feel free to hop in, say hi, and let me know what trades you're doing. I'd love to see what you guys are doing as well. So, guys, hope you have a great day. Hope you enjoyed this video. I'll catch you guys in the next video. Take it easy. Bye.